trading. So it doesn't matter whether you are trading Forex, it doesn't matter whether you're trading stocks or bonds or futures or options, the elements of technical analysis is going to be the same. So this is going to give you an alternative edge in risk and position management and also regarding your trading. So these are tools that needs to be implemented and used by all the traders, so to be able to give additional edge to your trading. One thing is also very important is to understand the classification of indicators. There are hundreds of indicators, if not thousands, but there are only 4 basic classes. These 4 basic classes are distinguished between their calculation methods. So the first, or let me put it that way, the very first type of indicators are trend following indicators. This is what we call lagging indicators. There are certain traders, or there are analysts who say that all the indicators are lagging. This is not true. Only person who says such thing is saying because he doesn't understand the calculations behind the indicators. Because there are going to be momentum type indicators which we are calling leading indicators. Now, if we are following a trend, just for giving an example, if we are following a trend, then a certain amount of lag should be included, because this is the only way to follow a trend. If we are talking about momentum indicators, these momentum indicators are going to be leading indicators. It's because of the calculations. According to the calculations of momentum indicators, they're going to give us very early signals, even to enter the market or exit the market, but they are going to be a leading class, and the trend following indicators are going to be a lagging part. Now, the very good thing about indicators is that they can be implemented in any kinds of technical analysis and should be part of technical analysis. Now, you can combine the trend following indicators with momentum indicators. I'm going to give you some ideas and examples how to do it. And also, there are 2 other types of indicators, the volatility indicators and the volume indicators. Now, volatility indicators is going to measure mostly the volatility of certain financial instrument, and also the volume indicators are going to give us information about the volume traded on those financial instruments. There's a way that we mostly hold these seminars, and it's like the following. If you have any questions during the seminar, I suggest you should put it on paper or an iPad or a note, and at the very end of the webinar we're going to have a questions and answers section, and all your questions are going to be answered at the end. So it's better to do it this way, because there are lots of participants, as I can see, and if you just put in your own question, it's going to be harder to answer. So we're going to have a separate section for that. All right, let's get on with it. So we're going to talk firstly about the trend following indicators. Now, to understand trend following indicators, first of all, you need to understand how a trend is established, how it works. Maybe in the webinar series of ours before, maybe you studied about trends and how to analyze trends, but the indicators are going to give you another way of seeing trends and analyzing trends. So this was the time when I was thinking about making a comparison of leading and lagging indicators and how they work. So as I mentioned before, the very first 2 main indicators, the trend following indicators and the momentum type indicators, are very different. So when we are talking about leading indicators, they are changing their values most frequently than the lagging indicators, the trend following indicators. So we can fine-tune these indicators to give buy or sell signals or even exit signals at certain price levels. Now, if we are talking about trend indicators, trend following indicators, the very basic trend following indicators are the moving averages. Okay, so there are lots of types of moving averages like the SMA, EMA, LWMA. These are the simple moving average, the exponential moving average, the linearly weighted moving average, and there are others as well. The only difference between these moving averages is the calculation method. The other main indicator that we're going to discuss here is the MACD or MACD or Moving Average Convergence Divergence indicator. It has been used by lots of technical analysts and lots of traders around the world, and it's quite a good indicator, and because with the help of the MACD you would be able to see the financial instrument in a different way. And there are other kinds of trend following indicators like the TRIX. This is a triple exponential moving average. We are not going to talk about this, but also there is the ADX, the average directional movement index, so lots of indicators fall into the trend following indicators section. So let's discuss first the moving averages, or also known MAs. So every indicator among the technical...
Maybe before you go ahead, Ferenc.
Okay. Yes?
Maybe before you go ahead, we must also mention it in a way that all the indicators are in a way that a person can perceive. Everybody can look at any indicator and will be having his own different overview on the methodical use of these indicators. For that reason, everybody tends to create his own strategy as well based on these indicators, or forwarding these indicators and creating extra mixed indicators. So these indicators that we are going to mention in the following webinar will be based on mathematical calculations, and everybody can create extra mathematical calculations for their own desires as well. It doesn't mean that you will be fixed to these indicators also. Yes, let's now go with the moving average.
All right. So one thing you should know about all the indicators, that every indicator should have a periodicity. This is going to mean that how the indicator is calculated. If we are talking about a 20 period moving average, or a 50 period moving average, or a 200 period moving average, it's going to mean that it will use the close prices of that certain financial instrument that you are trading. But you should also note that you could also use it with the highs or the lows or the open prices of certain financial instruments. So there is not just one way to use it, but mostly the most common periods and the most commonly used ways to use it on the close prices. But it's going to depend, of course, on your strategy. So when we are talking about periods for moving averages, the very basic periods are the 20 period, the 50, and the 200. Now, how can we use these moving averages in trading? You could use two or even more moving averages and look for the crosses. So, for example, if you put on a chart a 20 period moving average and a 50 period moving average, and you watch them closely, and when the 20 period moving average, this is going to be the fastest. I'm going to show you at the end how to put put on the chart a moving average or a MACD or the other indicators that we are going to talk about. So if you put it on a chart and you see that the 20 period moving average has crossed above the 50 period, which is going to be the slower one, then it can give you a signal for a bullish run. Okay, so some traders also say that this is immediately a buy signal, but there is also has to be other confirmations as well. And if the 20 period moving average crosses below the 50 period moving average, then this might give the signal for a bearish run. So there is a possibility for placing a short order or enter short at market, or just to close the previously opened long position. Also, there is a way just to use one moving average and watch the price, the relationship between the price and the moving average. A very simple method is just to use the 20 period moving average and say that if the close prices are above the 20 period moving average, then we are in a long trend. If it's below the moving average, in this case the 20 period moving average, then we are talking about a downtrend. And also it can be used by both indicators, all periods. There are also periodicities based on Fibonacci levels. So if you are familiar with the Fibonacci retracement levels, like the 50%, the 31.8, the 61.2%, these numbers can also be used for moving averages. Also, I know some traders who are using the slower moving averages. These are the higher period moving averages as support and resistance levels. So it can also be used in trading. The next type of indicator that we're going to talk about is the MACD. Now, what you need to know about the MACD is, well, this is called the moving average convergence divergence. It's going to measure the relationship between two exponential moving averages. If we put it on a chart, it will also show a zero line. You can look for crosses, and if there is a special kind of MACD on your MT4 or any other kind of technical analysis tool or charting software, then there is it can also show the difference between these two exponential moving averages. So it's going to plot the difference. It's going to give a signal line, and there is going to be a zero level. It doesn't have a extreme value, or it doesn't have a extreme long value or extreme short value, but it gives a different picture about the market. I think it would be easier if I show this. So I come up with a chart just for you to be able to see how this might look like. All right, so this is the Euro USD 1 hour chart. And there are a couple of ways to add an indicator or add, for instance, the MACD to the chart. The very first, I like this method. If we are going to the navigator here, and we drag it down, and here are the indicators. Now, one thing you should know that if you are using the MetaTrader 4 platform, there are also some pre-configured indicators, but you can also add your own indicators and add it to the chart. So if we are looking for the MACD, it's here. I just highlight it. And this is a drag and drop method. So you just drag and drop with the left mouse button onto your chart. Now, the MACD uses these standard numbers, standard periods. So the fast exponential moving average, this is the 12. The slow exponential moving average is the 20. It's going to plot the difference between the two, and it's going to plot a signal line, which is going to be a simple moving average, and it's going to have a period of 9. And as I told you before, there's the possibility to use the calculation on the close, open, high, low, even the median price. This is the high and low divided by 2. The typical price, high, low, and close divided by 3. Weighted close, high, low, close, close. So the last close is also weighted and divided by 4. But in most platforms, it's calculated on the close. So if I put it on the chart, it's going to look like this. So what we can see here is this histogram is basically this is the MACD, and this is the signal line. Okay, and what you can look for are again the crosses that we have mentioned in the previous slides. So if there is a cross, like the histogram here at this point are under the signal line, this can signal you a bearish momentum. Okay, and as you can see on the chart, it's going to give you the bearish momentum, and the bearish momentum is about to end right here at this close price. So here, all right, and here is another cross, excuse me. Yeah, it didn't made any rally, but again the close downwards. Here's the dime movement, the cross upwards. Not that much of an up movement, but what is very important is the zero line here. So this is going to give you the higher trend. All right. So if all the MACD numbers and the signal line numbers are above 0, it gives you a bullish trend. Okay, and the crosses can give you momentum signals. So this is a very good indicator for being able to even use it as a strategy. Okay, but I would say that you should use it as confirmational tool. Now, if we are here at the chart, I would like to put on some moving averages that we have discussed. So again, I'm going here at the navigator. Here at the indicator section, we're going to look for the moving average. Okay, here it is. In other platforms, it might be highlighted as exponential moving average or simple moving average or whatever. In the MT4, it's also a drag and drop again. In MT4, you can set the calculation method here and the period also. So if you drag down this MA method, it's going to give you exponential moving average, smoothed moving average, linearly weighted moving average. So you have the possibility to choose. You can play with it. I think you should play with it. So we are going to stick with the simple moving average, apply to. This is going to be close, open, high, or whatever. We're going to stay with the close and put in the value of 20. And just hit OK, and it's on the chart. Okay, and now if we are putting another moving average onto the chart, we're going to use this time the 50 period, which is going to be a yellow one. Also simple, also to the close. Now as you can see, this is why we say that it's the slower one, because it's going to follow the price from quite a distance, and it's going to react to the price changes not that actively, so very slowly. It's going to be a very lagging indicator. And if we are putting onto the chart the very last period, just a sec, moving average, again drag and drop. Let's put the period to 200. Close, simple, and let's put a blue, an aqua. And as you can see, it's more smoother. It again follows the price from quite a distance. All right,
The
and you
most
can.
well-known one of these crosses are actually called death crosses, and uh, death crosses are the ones that 200 moving average crossing over 50 moving average. And if the 50 moving average goes below the 200, it's a bearish signal. This is the most well-known signal that you will find from the moving average overall.
All right. All right. One thing we should know that the moving average is going to be slower. Okay. So as we discussed, these are trend following indicators. Every trend following indicator is going to follow the chart. So it's going to be lagging. Okay. This is very important thing to understand, and this is how they should be. This is why it should be implemented properly. Okay. Now I think we can go on with the slides. Now we're going to speak about the momentum class indicators. This is most of the time it's typically known as oscillators or leading indicators. Now most of these indicators are plotted in a way that it has a maximum value and it has a minimum value. Okay, so mostly the usage of these indicators are for forecasting peaks or bottoms on the charts, or when we are analyzing the trend, there are peaks and valleys, and we would like to see whether it's a peak, it's going to be a peak, or it's going to be a valley. So, and also there's a method for analyzing extreme levels. Now, when we are talking about momentum indicators, the very commonly known is the RSI. This is the relative strength index, the stochastic indicator. Also there's the momentum, or the ROC, the rate of change. And what we need to understand here is periods are extremely, there are also some extreme levels, typically used extreme levels that we're going to discuss with the indicators later. So firstly, the RSI, the relative strength index. Now this is going to measure the price relationship to the previous price movements. Okay, so this is a typical leading indicator. As you can see here, here's an example of the 4-in period RSI. It also has two extreme levels. One extreme level is the 30, and the other extreme level is the 70. Now this is basically this is the default setting. This was Wilder's idea. He was who developed this indicator, and when he said that when we are above the 70 level, then this is going to mean that the instrument is at a overbought situation. And when we are below the 30 period, or I mean, sorry, the 30 extreme level, then it's an oversold state. So you can look for the instrument for making a bottom here and a peak here. So this is a very basic thing to know. Also, we are just using the 4-in period. This is the base setting, but you can work out other period combinations as well. This was the very default period that you can see in most charting software, and also in the MT4. What you need to also understand that this is a fixed scale indicator. This is going to mean that it will show levels of 0 to 100. So it's not it's going to be a static indicator, as you can see. So it's going to oscillate all the time. All right, I'm going to show you this one. So the RSI is also found in amongst the indicators. This is the relative strength index, and we put it onto the chart. It has falling period as basic, and we just hit OK. I'm going to take the MACD down just for you to see the relative strength index. Okay, now how this works is very simple. You could use to identify overbought or oversold levels, but just by using the extreme levels. There are certain traders who say that the basic extreme is above 80 or below 20, but the very default is the 30 and the 70. Okay, so it's going to change its value, I mean the RSI, faster than the price. All right, so sometimes when we are comparing to, let's see, at this bar, we can see that the RSI level is approximately 43, and then the price only goes up a little, so little, but the RSI goes up more. And again, small movement in the price and more movement in the RSI. This probably going to show us that this is going to be a local bottom or a local valley here. So this can be also used. Also, if we are measuring some overbought and oversold levels in trends during trend periods, it's also a commonly used way. Also, there are traders who are using, just want to show you, relative strength index. We go, oops, just deleted it. Relative strength again. So here we go, edit. And if you go here to levels, we can change the levels like to 20 or to 80. And also we can add more levels like the 50, which is the center line. Yeah, it just showed up. So again, the indicator opens up by using this navigator panel here. You just click here. You can find the indicators here, or the custom indicators if you put some new indicators into the platform. But you just drop down this menu and drag and drop the desired indicator onto the chart. So if you're using this momentum indicator for measuring trends, it can also be done by either increasing the period number plus using the middle line, the 50 middle line. So a very easy interpretation is like if the price, if the RSI is above 50, then we are in basically an uptrend. Okay, now this period number is too small to say that we are measuring a trend here. So it has to be bigger, and the price follows that direction. You should use it in conjunction with other indicators or other technical patterns. Okay, so this webinar is going to focus on mainly the indicators, but you should understand that technical analysis is working in a way that it combines all the technical analysis tools into one and building up a trading strategy. All right, so basically this is the most important thing that we should know about the RSI. So again, the extreme levels, the default setting is 30 and 70, and maybe you should also look for the 50 line, which can also give you the direction of the trend a little bit earlier than the moving averages. But one thing you should understand that this is going to turn around much faster than any trend indicator or any moving average. All right, let's go on with the next indicator, and this is the stochastic indicator. It's also a leading indicator and also falls into the class of momentum indicators. it's going to measure the current price to previous price clusters. Now, we are not going to go deeply into the calculation of method. It's more statistical way. All right. It has also a fixed scale. It has also a 0 till 100 scale. It also have extreme levels, 30 and 70. And there are some commonly used periods like the 553. This is called the slow stochastic, and the fast, which is called the this is the 533 period. I'm going to show you how to put it on the chart and how to play with it a little bit. A commonly used way is to analyze it on multiple time frames. So if you will see that the stochastic indicator consists of two lines. It can also show you crosses like the MACD as I showed you before, but it's just going to show you the momentum, the current momentum. Either it's bullish or bearish. And if you combine it with multiple time frames, like for instance, you're looking at the momentum, building up momentum in the 1 minute chart, and you see also building up momentum on the 5 minute chart and on the 15 minute chart, then you are quite certain that the momentum is going to go up. All right, this is mostly a day trading technique. I had previously a colleague who used this technique quite a lot of times. You can also look for crosses and for the extreme levels. You can compare it to the RSI and see which one gives you the better signals. Also, there is the possibility of using these indicators to measure divergence. We're not going to go deeply into that. One thing you should know, divergence is basically meaning that the price is not going to a higher peak, but the indicator is going to a higher peak, or vice versa. So there is going to be so the movement is not the same on the chart and on the indicator, but we're going to talk about this later. Okay, it's a very good indicator to use in conjunction with other trend following indicators. All right, I'm showing you this one as well. So this is the stochastic oscillator. This is how it's called in the MT4. Now, this is it has the percentage K, the percentage D, and the slowing is 3. Now, if we use it like 5, let's put on the basic one. Okay, the price field is high divided by the low. This is the base calculation. Let's go on with that, and you'll be able to see. I'm going to show you. You will be able to see it on a different, little bit differently. Okay, with this indicator, you can also look for peaks and valleys. So it's more a signal based indicator. As you can see, it's just oscillating and trying to measure a momentum in the price and forecasting some momentum into certain direction. As you can see, there are 2 lines. Crosses are the things that also you should look for. Like for instance here, there's a bullish momentum coming up, and then yeah, it really did. And then a bearish cross here. Yes, bearish momentum again. Bullish cross here at the close of this price, and there's the bullish movement, and again downward movement. And also, as you can see, there are the extreme levels. A strategy is to look for bearish crosses above extreme levels, like this overbought level here, or this oversold level here. Okay. Again, there are traders who use the 50 line, the middle line, but I think for the stochastic, it's quite good this way. On the other hand, I just want to show you if we are just modifying the periods like the slow one. Now the slow one is it's going to react the same, but it's more smoothed. So it's going to give you fewer signals, but we say better signals. So a way to use this is in conjunction with, like for instance, moving averages. Determine whether it's in an uptrend or downtrend, and let's say if it's in downtrend, then we look for only for bearish momentum signals. Okay, this is a way to use the stochastic. Also, you can play a little bit around with the periods. I'm just right-clicking again. I'm just right-clicking on the chart, going to indicator list. Let's click on that, and we highlight here the stochastic oscillator. We go here to edit, and we can put in, modify the colors. We can put in additional levels onto the chart, extreme levels like here, the 80 and the 20 period, and also play with the visualization. All right. All right. So, volatility indicators. This is coming up next. So, we're going to go here into a little bit into statistics, because we're going to talk about here Bollinger Bands and the average true range indicator. But you need to understand what volatility means. Volatility means that the price of a financial instrument is changing a lot. It goes up a lot, it goes back a lot. Now we say that too big volatility is not good, because the price goes into one direction in a very big amount, then it corrects back again a very big amount, and if you are in a long position, it might get you stopped out. Also, too small volatility is again not good, because then the price is not moving at all. There are not really possibilities to grasp and to profit from. So basically, the thing is to measure volatility in a different way, and to find possibilities where volatility is not too good. Of course, it should depend on your trading style. Okay, now the Bollinger Bands is basically it's a combination of a trend following indicator and a volatility type indicator. Now it consists of a moving average and its standard deviation. Now I have a chart here that I wanted to show you. Hopefully you will see it. No, you won't see it. Okay, now you see it. This is I'm not going to go deeply into what standard deviation is, but hopefully those who have learned a little bit of statistics, they would know. So standard deviation is the deviation from the expected value, or from the mean value, or in other words, from the average. Okay, and if we are talking about standard deviation, then there are going to be standard deviation levels, and this is going to mean that let's pick up, for instance, the one standard deviation is going to mean that all the data that are included into this density function here, this is the density function of a normal distribution, it's going to represent all the 68.2% of all the data. Okay. Now, if we are talking about the two standard deviations, so it's the deviation again from the mean, either to the positive and to the negative side, it's going to include more than 95% of the data. Okay. and if you're talking about the 3 standard deviation, as you can see, it's going to have almost all the data, 99%, more than 99% of the data. Now, if we put it this on the chart, as you can see here, just a sec, I'm waiting. Okay, as you can see, the moving average here that is plot, there is these 2 bands that that also appear, and this is going to mean that the close prices, if this is the basic 2 period, then it's going to have 95% of the data between these 2 bands. So if we say the interpretation is like this: if the close price is above or below the standard deviation channel, then it should revert back to the mean, which in this case is the moving average. Okay, so this is also a way for looking at overbought or oversold levels, and there are traders who also use this indicator as a trend following indicator. Okay, so again, there are lots of ways to use the Bollinger Bands, but one thing you need to understand that the reversal way is to look for closes outside the bands and then look for reverting back to the mean. Or others also say that another interpretation is like this: if the close prices are above or below the bands, then it's a very strong momentum to that side. So if it's the upper band, it's a very strong bullish momentum with which we think should continue. And after that, when it starts falling back, we should see the price fall back to the statistical mean, which is in this case is the simple moving average. Okay. Another interpretation is like this: if we are looking for the bands to shrinken or to narrow, then we look for breakouts. So in this case, we can see that the bands have narrowed, and if there is a breakout to one of the directions, then this should be the direction of the next momentum. Okay, so in this case, you should see that it's a bullish breakout, and we look for the follow-up movement, which is a bullish movement. Also, if as you can see, if the highs, the close prices are very far from each other, then it's going to mean that the bands are going to widen. This indicates that the instrument is in a high volatility state. Okay, but the interpretation, it goes the same. And of course, the middle line can be used as a simple moving average, as it is. Okay, and now I'm going to show you how to put it on the chart. Again, so I'm going to clean up a little bit because there are lots of indicators here. Right click on the chart, go here to indicator list, highlight it, and I just highlight the moving averages, and I just delete them one by one like this. Okay, and just drag and drop. Here is the Bollinger Bands, and I just drag and drop onto the chart. It gives me the panel where I can set the periods. This is the standard, the 20 period, and the deviations of 2. Okay, if the shift is just shifting it to forward or backward, I'm not suggesting it, because it's a little bit, it gives more confusion. So let's stay with the 2 standard deviation band, and let's put it like yellow. All right, so it's now on the chart, and the interpretation is the same. You could use it for looking for periods when the bands are narrowing, and you look for breakouts is the bearish breakout. There's the follow-up movement. You look here again. Here's this narrowing state. Here's the breakout. Here's the follow-up movement. And as you can see, when you're outside the band, it's going to indicate you that the momentum into that direction, if it's the lower band, then the bearish momentum is going to be strong and it's going to follow up, hopefully. Okay, and again to the other side. It's a very huge candle. Don't forget this is a 1 hour chart, so it's a different thing. So again, there is a smaller momentum to the upside. And again, well, these are high volatility states. Okay, it made a few breakouts, false breakouts. So there is no holy grail in technical analysis, but you can also use it to your strategy. You can implement. Oh, as you can see, this at this state, the movement back, the reverting back to the mean is what was the most good, most best situation here. Okay, and the baseline, don't forget about it. The baseline is the simple moving average. And if you are plotting the two standard deviations here, let's put a 3. This is the deviation setting. Hit on OK. Close the chart, and it's going to mean that 99% of the close prices should be inside the band. Okay, so it's going to give you fewer signals. All right. So the higher periods should be used more as turning than reverting back to the mean. So it shouldn't be used like previously if there is a close price below the standard deviation band to give a follow-up movement, but rather to expect the price to return back to the mean, which is the moving average here. Okay. Now this is the standard deviation of Bollinger Bands, and the last one here is the ATR. This is the average true range. Now this is also a volatility type indicator, and it's going to give you and measure you the high-low distance. Okay, the average high-low distance basically. So it measures in pips, ticks, cents. It depends on what kind of instrument are you trading. So if you're trading the Forex market, then it's going to show you in pips. If you're trading futures markets, it's going to show you ticks. And of course, if you're looking at stocks, then it will show you cents. Now there are quite a few usages of the ATR. Good for determining stop loss, very good for determining profit levels, and most of the traders are using this as they are using the multiples of the ATR to put stops and profit targets. And also I also know a technique which is very powerful to use the ATR with the ADX. We are not going to speak about here ADX, but maybe you should do it as a homework. And basically the ADX, the average directional movement index, is going to give you the strength of a certain trend, whether it's a uptrend or a downtrend. And as long as you get positive values, increasing positive values, then it's going to show you that it's the instrument is in a trending period. So it's not going to show you the direction of the trend, but rather is going to show you the strength of the trend. So as long as the ADX is rising, then you should use certain multiples of the ATR level to determine the profit target and the stop loss level. I'm going to show you it's a little bit more easier to see. I'm taking the Bollinger Bands down. I'm deleting it. All right. Then average true range, it's highlighted at the beginning. And I just drag and drop to the chart. Again, the period, it depends on you. You should make some, you should play with it. I'm deleting the relative strength. I'm leaving the other one up. So this is the ATR. All right. So it's going to show you the high volatility states. So here at that price level, the volatility. Okay, I'm using this crosshair here. This is data window, and if there are indicators up, it's going to give me the value. So at this point here, and I'm pointing at the chart, the 14 period ATR gives me a 9 pip. So I should look for a very according to the strategy that I have told you about, that if you're using it in conjunction with the ADX, then let's say we should use the multiplier of 2 or 3. We should do some analysis regarding this. Then you multiply. If you have an entry, you multiply the ATR by, let's see, 2, then it's going to give you a value of 18. Now this is going to mean that your profit target is 18 pips away, and your stop loss is also 18 pips away. So it's a way to put the stop loss, like if you are using trend analysis. And let's say that we say that from this level here, it closed up, closed above the previous high, and then we say that it's a breakout or an uptrend, and I would like to place my stop loss, and I say that let's put the stop loss under this valley, and okay, but under how much? Let's see the ATR level. The ATR level is 12. Okay, it's shown here. At this close, it was 12. So I would say that I would place my stop loss 12 pips, like here, 12 pips below this valley here. Okay, or if you are using the breakout, and you would set a target, then you check out the breakout bar here. For example, this one, you closed above the previous high. You check the ATR level, it says 19, and you use the, I don't know, multipliers of 2, and it's going to give you the number of 38. Then you say that 38 pips, which is over here, is your profit target from this trade. Also, you can put 38 pips of stop loss here, and it's going to adapt to the certain to the current market conditions. So if there is a harsh movement to the upside or to the downside, then the ATR is going to give you higher numbers, and if of course the highs and lows are closer, then it's going to give you smaller numbers. So let's see now what's next. Again, the period depends on your strategy, and but the most commonly used are the 14 period. You should play with that and see how it works, how it fits your strategy. I think this is the part for this is the end of this seminar. So the questions and answers section should be now. So if you have any questions regarding this webinar or everything that you heard about, please feel free to ask, and me and Yabub are going to answer these questions.
In the meantime, while you are typing your questions, let me also give you information about iron effect. With all these webinars that we are hosting, we intend to give you the opportunity to learn about Forex trading, and for that reason we also provide demo accounts where you can basically start trading with a virtual money that basically does not exist. It's a training account. So you can already start yourself a training account, demo account with $100,000, euros, pounds, whatever you would like in it. Even participate in our existing competition. Maybe you can even win any of these competitions. We have monthly demo competitions, bi-weekly live competitions, which you could also participate. Furthermore, shortly a bit about RNFX. We have been chosen as the best Forex broker of the year 2013, and with best trading execution globally in 2013. In addition to this, we are regulated and licensed by various global leading regulators. Maybe Ferenc could go to the next slide.
All right. Yes.
About
certainly.
And with all these regulations like ASIC, MiFID, FCA, or formerly known as FSA, BaFin, SciSec, CFSA, all these regulations will be the guarantee for your own security, either the personal security or funding security. Further to this, all your funds will be, with RNFX, segregated and kept in AAA leading, AAA rated leading worldwide banks, giving you the fund safety as well. We already have quite a number of questions coming up. I'll go through these questions one by one. Either me or Ferenc will be answering these questions.
All right.
Okay. The question is, hi, for each time frame do we have same setting for indicators?
Yes, basically the indicators periods are going to be the same. It just depends on what kind of time frame you are using. On higher time frames, what we can say about mostly Forex, that it looks more volatile. So the lagging indicators will be more lagging. So you should play with it a little bit, but the default setting is and the default idea is to use the same period on the desired time frames. You should do some visual backtests. You should check how it works, how it behaves on certain time frames. But the main idea is, yes, to use the same periods on different time frames. But I also met a few traders who are using different time frames, and they are using different periods of indicators on certain time frames.
It also depends on what type of a trader you are. If you are a scalper, of course you will be using all these indicators that you would choose on smaller time frames, such as 1 minute, 5 minutes, or 15 minutes. If you are an intraday trader, which means that you only open few trades per day, then you would be using these indicators on 1 hour or 4 hour time frame. However, if you are a swing trader, which is a long-term trader, maybe once a week entry or once a month entry, then you would be using these indicators on longer time frames such as daily, weekly, or monthly. So it depends on your personal strategy. It depends on how you perceive these, and it depends on, of course, how much time you have to trade. If you have further questions on this subject, please go ahead. In the meantime, we'll pass to the next question.
Okay. The next question is, please say again about the value of SMA, EMA, which you have used. Okay. So this was the three main periods that technical analysts are using. This is the 20, the period 20, 50, and the 200. This is widely used among technical analysts and also traders, and these three periods considered to be working better than other periods. But again, it depends on the instrument that you are trading, the time frame, of course, what you are trading. These periods are derived mostly from the stock market, because if you are analyzing the stocks, most of the investors are looking at the daily charts, and if we look at the 20-period moving average, then this is going to give us a month average, a monthly average. Okay, there's the 50 period and also the 200 period. These are interpretations of months and of course fitted for the publications of companies. But again, you can use everything.
Interpretation.
Okay.
It's basically interpretation for you, the monthly, quarterly, and yearly way of interpreting the time frames. And each time, if the 20 moving average passes above the 50 moving average, it means it's an indication that on the shorter time frame, which is daily or maybe weekly, if you are using daily chart, by the way, it means that the trend is turning into bullish. The most important of these that I have also mentioned earlier is the golden cross and the death cross, which happens on 50 moving average and the 200 moving average. If the 50 moving average is passing above 200 moving average, this is called golden cross. This is an indication of strong bullish trend, uptrend coming up. On the other hand, if the 50 moving average goes below 200 moving average, it's called death cross, and it's a very bearish signal that happens on different time frames. You can it again depends on what time frame you use. These ones that I'm mentioning happens on most of the traders will look for on daily and 4-hourly time frames. We have Lloyd asking if you can look at the recording of this webinar as a replay. Yes, you will be able to look at the recording. However, this will only happen after the 15th of September. There is a new section on ironfx.com coming out called as IronFX Academy. In this section, you'll be able to see the webinar recordings, etc. In addition, we will also have extra educational information in this section. We are expecting it to come out by 10th or 15th of September.
Okay, there's the next question. Like, what is the relationship between the MACD and higher time frames? Well, there is an exact relationship. Let's just put it on and see. So it doesn't matter what kind of indicator you are using. What mostly matters is the periods that you're using. The MACD has a basic period of 12, 26, and 9, and you should check it out, because it depends on mostly what kind of instrument you are trading. So if there is a instrument that most likely to be trending, then you should be using the trend following indicators and the momentum indicators for entering into the market. But again, if we are going on higher time frames, then because of the bigger candles here and the far further away closing prices, it's going to widen up. The MACD is going to diverge from each other. I mean the signal line and the MACD line. So you need to practice a little bit with it and see on which time frames can certain indicators be used. Okay, everything can be used everywhere, but you need to understand that you're looking for high possibility trades or high possibility opportunities, which is only used if you are able to grasp those situations. So play around a little bit and check them out and see what period works on what time frames better, because there is such thing that on certain time frames certain periods work better because the characteristic of the price movement is different. Okay.
In addition to that, the smaller again time frame you go, the smaller your targets become. On the other hand, the larger time frames you go, the larger targets you've got because of the volatility in there. Within 1 minute period, you cannot expect targets of 200 or 300 ticks. Whereas if you are trading on daily time frame, of course your targets will not be just 5 ticks. Your targets then will be changing to at least 50, 60 or even 200, 300 ticks target. The next question we have is what indicators or strategies that makes you decide to enter a perfect short position on your USD?
Oh, this is a funny question, I see. There is no such thing as Holy Grail. Okay, we are looking, if we are using technical analysis and or either fundamental analysis or quantitative analysis, we are trying to pinpoint on the charts or in the books or amongst the numbers those situations that give you the highest probability of being able to profit from a certain move. There are going to be false signals. There are going to be false trades. What really matters is how you are able to deal with those situations. So one thing to bear in mind is the more signals you have, the more possibility you have for making it a wrong signal. So I hope you understand. So the more signals you have, the more chance you have for signals to be wrong. Okay, you should be selective, and you should use indicators in order to be selective. So I think this might answer your question.
In addition to this, the most important part of trading is not the analysis. Even more important part is about the risk management. You can even give trading to a child, and he might make it a lucky shot with good entries. But if you give it to a child and he just enters with weird targets, 1 pip target entry and 200 pip stop loss, you have to make 200 times profit in order to cover one of your loss. So for that reason, you have to be very selective on your risk management as well, which we are also going to cover this subject as well in our upcoming webinars. There is one question which is called, how can we use the quicksand channel? I don't understand this.
Which one?
The one, the very first one. How can we use a quicksand channel? If you can elaborate on it, please. Asif Ali.
Equidistant channel. Yeah, we haven't been speaking about equidistant channels. Maybe you are might be referring to um, this one here. This is the equidistant channel. This is a drawing tool. We haven't discussed drawing tools, but maybe in a future webinar we can talk about it, because it's again the method of drawing trend lines and using the equidistant channels to forecast a trend basically. So
This section is mostly used for determining the flags, the uptrend channels and downtrend channels. So we will also have a section called the candlestick formations, which will cover these and furthermore. The most important factor while selecting a channel is the fact that you have to be able to determine the ups and down parts of the channel, and you have to be able to determine your targets within this section. It works similar to Bollinger Bands that my colleague has just talked about. However, on these channels, it is quite often if it's working in a way that if it touches the upper boundary, it is supposed to go ahead and touch the lower boundary, not just touch the mean and come bounce back again. I hope this answers the question.
okay, and there was another question which was about overbought etc. I didn't really understand this question, but I think the bottom line here is there are certain ways to use indicators, but there are traders who have established other ways of using these indicators, which might be completely different what it's told in the books. So many ways, many possibilities, many ways to profit from the market. So we just covered here a very basic material, and we're going to follow up, of course. So we're going to have further webinars in this theme. So hopefully you are also looking forward to it, and maybe we're going to meet again and further broaden our picture about technical analysis and trading the financial markets. Okay, I think that's all for today. Thank you very much for attending to this seminar, to this webinar, and hopefully we're going to see you in our next one. Thank you for listening.
Thank you very much. Thank you very much, everybody, for your time and for your attention. We'll be sending furthermore invitations for our upcoming webinars. These webinars will start to be continuing based on series. As we have said in our earlier webinars, we tend to provide an academic webinar